If you can describe something, you can code it. You may not like to code it. You may not know how to code it, but in time, you will work it out. So for me personally, I wouldn't leave anything to the discretion.
Today I'm sitting down with Brent Penfold. We sat down together a few times in the past. We interviewed him in the past also a couple of times. The author of the Universal Principle of Successful Trading and a few other books, a recent one also. So how's it going, Brent, today?
Oh, very well. Thank you, Etienne, and thank you for having me on.
Awesome. Good to catch up. It's been a while. Last time I spoke to you, you were just about to publish your book, which you did publish now. So tell us a bit more about what's in that new book.
Oh, sure. Yeah. Just after we last spoke, my third book, The Universal Tactics of Successful Trend Trading, was published by John Wiley. And I'm really pleased with it. I'm not sure about you, but I know in the past, when I discover an author, it's usually because a lot of people are talking about the book and you buy the book and you go, yes, it's a fantastic book. And then when a subsequent book comes out, you're quite excited and you'll buy that book. And quite often that subsequent book doesn't really live up to that first book. And I don't want to fall into that trap of just producing a book for the sake of producing a follow-up book. And so I feel that this third book of mine, The Universal Tactics of Successful Trend Trading, is very solid, and I'm very proud of it. So it's a good follow-up book to my Universal Principles book. I actually see it as the missing chapter from my Universal Principles, which I published, or John Wiley published, in 2010. And if you remember that book, it was a book that was just talking generally about the important principles that regardless of which markets you trade, regardless of which approach you follow, regardless of what time frame you prefer, and regardless of what instrument or markets you trade, there are these fundamental principles that you have to embrace to survive in this dynamic arena called global markets. And so it was a very holistic book. And I did spend quite a bit on methodology, but it was from a holistic level, while the subsequent book is more of a how-to guide. And so it's focused purely on methodology. And so I hope, I'm sure I've demonstrated that holistic approach I was talking about in a practical sense in my new book.
Interesting. And definitely the book on the Universal Principle was more about psychology, about the risk management. You talk a lot about the risk of ruin, trading based on data, these kind of things. And these are very important. Would you suggest someone start with these things first if they want to learn to trade, or should they start with a methodology, the strategy before they learn these principles?
Great question. And nothing's changed. We know that there's three pillars of successful trading, and you have to embrace and understand and comprehend and execute these three pillars of money management, methodology, and psychology. They're all important. And what I rank, the most important is money management, followed by methodology, followed by psychology. But even more important than that is a key concept called risk of ruin. If the only thing people take away from this podcast is a strong message that they need to understand what risk of ruin is, then you and I would have done that person a great favor, because by understanding what risk of ruin is and peeling back the layers, right, that will open up a huge world of tangible and correct and required knowledge on how to be successful in trading, because it brings in two of the biggest value drivers which determine whether you'll enjoy a rising account balance or a declining account balance, which is risk of ruin. And my boys now, Bo's 16 and Boston's, he's 14, and the boys don't really show much interest in what I do. But my oldest boy have friends who are, they're trading cryptocurrency and they're getting into trading, and they've come across my name. So they've been asking Bo all these questions, and Bo goes, I don't know. I don't know what Dad does. And I was dropping off one of these boys from soccer training the other night, and he was very polite, and respectful, and he was asking me questions, and he said, if there was one piece of advice you could give me, what would it be? And I said, simply, you need to understand what this key concept is: risk of ruin. If you can understand that, multidimensional, from under it, from the top, from the sides, you will just be such a knowledgeable trader, far more knowledgeable than probably 85% of all traders. And it's from that everything springs. So it's just like, because there's so much in trading, isn't there? There's a hell of a lot to cover. But if you can point somebody, say, pick that piece up over there, that risk of ruin, and get your head around it, and know that you need to be able to measure what your individual risk of ruin is, and understand that as soon as you engage with the markets, you will have a probability of losing it all. And wouldn't you want that to be a low percentage, like 0%? Right. Most people would say yes, right? So nothing's changed. Risk of ruin. And within the two key components of risk of ruin, money management. That's got your biggest influence on leveraging your risk of ruin down to 0%. Okay, that's because it's when you do the sensitivity analysis, money management's got the greatest influence on your risk of ruin outcome. Yeah, so nothing's changed.
But that's a good phrase you just said right there. So the fact that any kind of trading has a chance of you losing your account, losing everything you have, it's a possibility. And from there you could think, if I just build the skill of trading, I'll be able to not lose my account, but there's still a risk of losing it. And that's why I think that risk of ruin is so key and so important. Now, tell us what that would look like, because you can very simplify this. You can be like too simplistic around it and kind of understand it a little bit, but not really apply it in trading. So what does someone who understands the risk of ruin should do to be able to protect their trading and protect their balance toward trading?
Somebody who's trading now?
Yeah.
Well, if they're a mechanical trader, first of all, they should do an audit on all the historical trades, right? Regardless of whether they are mechanical or discretionary, do an audit, get your trading statements out, and work out what your average win is, work out what your average loss is, to calculate your expectancy, because expectancy is a function of your average win versus your percentage of wins added to how often do you lose and the average win over the average loss. So you need to calculate your expectancy. And to do that, you go through your archives of trading statements and you calculate your average win and your average loss. You work out what your percentage win rate is, and that calculates your expectancy. And then you should calculate how many units of money are you risking or trading with, given the way you do your money management. Okay, there's many different ways or approaches to money management, but you can all drop it down into one bucket of, okay, regardless of which money management lane you're in, it will come down to how many units of money you're trading with. You combine how many units of money you have with the expectancy of the way that you've been trading, that will produce a mathematical risk of ruin. And if it's above 0%, then you have to tools down and stop trading, right? Stop trading. Even if it's just 5%, which is low, you're still guaranteed to go bust. It's just that you'll survive longer than somebody who's got, say, maybe a 20% risk of ruin. So do an audit of your trading statements for the last 6 months, 6 years. What's your average win? What's your average loss? What's your win rate? And as you allocate money from your account to trade, how many units of money are you trading with? You put that together and you calculate your risk of ruin. Now, there's no simple single formula to calculate that if your average win is different to your average loss. If your average win is equal to your average loss, there's a very simple formula in my book that you can calculate it. But most people's average win is different to their average loss. And so what they need to do is you run a simulator that just runs 10,000 iterations and comes up with a number. And I talk about that in my universal book about developing your own risk of ruin simulator in Excel. And I also tell people that if designing macros within Excel is beyond them, they're more than welcome to contact me and I'll give them a copy of my little Excel risk of ruin simulator. what you do is you put in what your audit says. What's the average win? What's your average loss? How often do you win? That's your expectancy. How many units of money in? You put that in and you hit the simulator. And you need to run it 30 times so you get a statistically significant calculation. And if it's above 0%, you shouldn't be trading because your risk of ruin is too high. Even 1% is too high. And that should, open people's eyes to say, well, I'm silly to be trading the way I'm trading because sure, I still have money in my account, but the way I'm going, I'll eventually end up going bust. Yeah. And then once you've done your audit and you're here today and you realize that your risk of ruin is too high, then you need to get it down to 0%. And you'll have a good understanding of how to do that because the two big inputs are your methodology, the expectancy, how you trade, and how much money you risk per trade. That's your money management. And so you work those two to get you a positive, a 0% risk of ruin. Now, as a really broad brushstroke, I can tell you that if you had, say, a strategy that, say, only wins 60% of the time, if you develop a strategy, right, and it wins 60% of the time, and say the average win is equal to the average loss, right, that will give you an expectancy of 20%. So if you win 6 out of 10 trades and your average win equals your average loss, that gives you an expectancy of 20%. If you have at least 30 units of money, which is not a lot of units of money, I've got to say, it's quite small, but even with 30 units of money, with a 20% expectancy strategy, that will produce a 0% risk of ruin, as long as the equity curve on your methodology is stable. If it's fragile, then that 20% is just academic. It's not robust, right? But if you feel you have a robust strategy that will continue tomorrow to win 6 out of 10 trades, average win to the average loss is 1-to-1, and you have at least 30 units of money, then you'll be trading with a 0% risk of ruin. If you've got a really high accuracy system, a lot of people I know are attracted to day trading because they can go home square and not have the overnight risk. People can develop really high accuracy systems. The only problem is that when they lose big, right? But they can still trade with a positive expectancy. If you had like a strategy that wins 9 out of 10 times, and the average win is only 0.2 to the average loss of 1, so your average win is 20 cents to your average loss of $1, right? So we know that your wins are very small compared to your loss, right, which is $1. You win 20 cents and you lose $1. But if you win on 90% of your trades, that gives you a 10% expectancy. But because your expectancy is lower, you have to lift up the number of units of money you're trading with. So rather than having 30 units of money, that if you traded with a low 10% expectancy strategy, that would give you a risk of ruin above 0%, and that's no good. But if you had, say, 50 units of money, trading a 10% expectancy strategy, you'll be trading with a 0% risk of ruin. So they're just some rough numbers. If your strategy is producing 20% expectancy, and you have a stable upward sloping equity curve into the future, and you haven't over curve fitted your strategy, you haven't data mined the data, if you haven't fallen into those traps that a lot of people fall into regarding development, so you have a stable 20%, you can trade with 30 units of money and you'll be fine. Similarly, if you have a low expectancy strategy, only producing 10%, but you're trading with a stable equity curve, right? And you have at least 50 units of money, you're okay.
Interesting. So just to precise those units of money, because I was trying to figure out myself, but basically you're saying if you have, let's say, $30,000, $1,000 would be 1 unit out of 30 units of money you risk per trade.
Yeah, that's right. Yeah. So you cannot risk more than $1,000 on each trade, and that will give you 30 trades. And if your way you trade, if it has a stable equity curve, if it hasn't fallen into the twin traps of data mining and excessive curve fitting, then you will make money. because it's a 20% expectancy. So you will be earning 20% on what you risk.
What would be the advice for someone who hears this but doesn't have any profitable strategy yet? Like they're trying to trade, but either they see they have more losses than wins, or they lose more than they win, basically. What would they do? Because they cannot calculate the risk of ruin that way.
Yeah, well, they've got to develop a new strategy. So if historically, after I did their audit, it showed that their risk of ruin is like 10%, 15%, 20%, 40%, right? They know they have to stop trading. And what basically they're trading with a negative expectancy methodology, right? It's negative. You have to produce a positive expectancy strategy. So you got to develop a methodology that works, right? And that's probably where you and I spend most of our time. And it's probably because once you work out how to trade, the business of trading, it's very prescriptive. It's like joining the dots every morning. It's a job. It's repetitive. There's nothing exciting about just trading, right? What I find enjoyable is trying to reinvent my mousetraps, trying to find a better way to do things. And that's the most enjoyable part for me, is the discovery process of developing a sharper knife, so to speak. And how to do that, essentially, and I talk about this in my universal tactics of successful trend trading, about how somebody can go about on developing a strategy. So they've done the audit. They suddenly realize they've been trading with a negative expectancy system, which has given them a risk of ruin above 0%, that they have to step away from their keyboard, leave the trading account alone, and they're going to start again and develop a positive expectancy strategy. Essentially, you need to get the proper tools available to you, okay? First of all, in my opinion, you need to develop or select a universal portfolio of markets. But essentially, the two big missteps people make in developing strategies is they data mine and they have excessive curve fitting. So data mining is people will only look at those markets that their ideas work well on, right? They may focus on interest rates or equities or currencies, and they may develop a strategy that does very, very well on those, right? Well, yes, they have, but it may not be as robust as I think they are, because they've only developed it on the markets that look good to them. So even though you may only want to trade currencies, you should develop your strategy on a universal diversified portfolio, so that you can prove to yourself that what you're developing is robust and is not a function of data mining. Okay, so sign up to a data provider. There's a lot out there, and select a large portfolio of markets that are basically independently and objectively selected. Okay, so if you trade, say, equities, you can't put into your pool of equity markets that you want to trade, you can't put your favorites in there like Apple and Google and Netflix, all those ones that you're familiar with, right? If you trade currencies, you just can't put your favorite euro dollars in there and British pounds in there. They may end up in your portfolio, but you need to develop some objective and independent selection criterion on how to create this pool of markets, right, that you're going to test your strategy on. If your strategy is going to be robust, make money in the currency markets, then by definition, it should be able to make money over a diversified portfolio. So you want to create this big pool of markets, right? What I do is I trade futures. And so I basically trade 30 markets in total, but my diversified portfolio contains 24 markets. And what I do is I select the 3 most liquid futures contracts across the 8 market segments: indices, currencies, interest rates, energy, metals, softs, and grains. And out of those, I select the 3 most liquid contracts. So I don't care whether it's Netflix or Apple or 10-year bonds or 5-year notes. I don't care whether it's Japanese yen, Swiss francs, Aussie dollars, whatever. So you need to create like a large pool of markets to test your ideas on to avoid data mining. Now, even though you may only trade interest rates, you may only be able to afford to trade currencies, right? Fine. But when you test your ideas, don't just test it on interest rates and currencies. Test it on a large pool of markets and make sure you select those markets on an objective and independent basis, right? You can't have any influence on which Netflix goes in there or which currency pair goes in there or which particular interest rate goes in there. You got to, articulate your criterion and then say, based on these criterions, these are the shares that go in or these are the markets go in, right? So that's first of all, get your data, get software. You need to have software. You need to learn how to program up ideas. Sure, you could do it by hand, but it's going to take you a month of Sundays to back test ideas. In addition, I'm a big believer in that people should select what I call a strategy benchmark, okay? Because another trap people fall into is what I call the relevancy trap. People want to be relevant, i.e., generally traders want to only trade strategies developed by their own hands because they tie their self-esteem to their own creation, right? And so I'm saying, I understand that. I've done that for many, many years. I only want to trade what I develop, right? But I've come to an age now where I think, no. My self-esteem as a trader should be purely tied to my account balance. That's the only criterion, not how I got there. What's the result? Is it going up? Then I should be happy. And so I think people should select an independent strategy that works. And there's plenty of publicly available strategies out there they're good. They are good. Pick one that you understand and you like, right? And say, whatever I develop has to be as good, if not better, than your benchmark. Yeah, right? Because you've got to avoid the relevancy trap, right? You've got to avoid that trap that you want to trade only strategies developed by your own hands. Now, that's rubbish, right? You want to develop strategies that are robust. Who cares who developed the strategy, right? So you need a benchmark. In my book, I recommend the turtle strategy as a benchmark. I think it's one of the best publicly available strategies for a number of reasons. Firstly, it's very simple. It's only got two rules in it and two variables. And it's super robust. It's been known for like almost 40 years and it's still making money. So it's simple and it's robust. And so it's got great performance metrics. I'm not saying it's the best strategy, but for the average Joe trader like you and I, that is something to aspire to beat. And it's going to be really hard for most people to beat it, right? A combination of simplicity, performance, and out of sample longevity, right? So that's your benchmark, right? So it's like a boundary that says, okay, we can go crazy here developing an idea, fine. But once we're finished, one of the final steps is to say, is it as good as the turtle strategy? Now, it won't be as good in terms of proof of robustness because you have no out of sample data, right? You have none because what you produce is new. Turtles has been known for 40 years, right? So you can never compete with the turtles on terms of longevity. But can you compete with the simplicity? Is your strategy as simple as the turtle strategy? Because what simplicity gives you is it gives you stability in your equity curve. Strategies that are complex usually have fragile equity curves that eventually dip because they've been too curve fitted, right? And then in terms of the metrics, it's very profitable, the turtle strategy, right? But there are some things that you and I would not really feel comfortable with. It's got a very high average stop, like 2.5%, 3%, because it's a long-term trend trading strategy. So it's not perfect, but you need, whatever you come up with needs to beat that. So you need your data, you need your software, you need a benchmark, and then you need to have a really good understanding of three key things. You need to understand how markets behave. You need to understand the attributes of winning strategies, and you need to know what the risks are. In terms of market behavior, you need to understand how markets work so that what you're attempting to do is sympathetic and aligned with how the markets behave, right? Have an understanding of what markets do, and don't try and develop something that goes against it, right? Don't go against the grain. Like a simple example is, we know if you look at the distributions of daily price changes, that prices do not follow a normal distribution, okay? And what they have is what's called fat tails. Fat tails in the distributions legitimize, prove that markets trend, okay? So we know markets trend. So looking to trade the trend, big tick. And there's a lot of other ideas of mean reversions, about cycles, about sentiment, about momentum. Now, understand some key market behaviors so that whatever you attempt to build is not contrary against these key market behaviors. You need to understand what the key attributes are to winning strategies, because you hope that what you build will become a winning strategy. So you want your winning strategy to have as many of these boxes ticked off. The two key attributes of winning strategies is, one, they're measurable. You know, are your rules clear and simple, and can they be coded up, and can you produce an historical equity curve? And secondly, robustness, right? Robustness. That's a second key attribute of winning strategies. They're robust. There's only two ways you can judge robustness. One is proof, right? How long has the strategy been in existence? Has it been 1 year, 5 years, 10 years? What's the equity curve being like on the out of sample data? So that's good. Most people don't have any evidence of robustness because what they're designing is starting from scratch. So you need to understand what are the indications of robustness, right? What are the indications of robustness? And there's a couple of key indications that you need to ensure that you incorporate those into whatever you develop. First key indication of robustness is your strategy is versatile, it's profitable over a large pool of markets. Remember, we want to avoid cherry picking. Yeah. So even though we may only trade a couple of markets, right? That's all we can afford to trade. You need to ensure that what you've built has legs and is profitable over a diversified, objective portfolio of markets. Is it versatile? So if it is profitable over, a large portfolio of markets, then that's a good indication of robustness. And then secondly, good design. So elements of good design: simple is better, few rules, few filters, few variables, few indicators. You want homogeneous setups across markets. So you don't want any tweaks on your setups between the metals and between energy, or between the grains and between the currencies. So you want homogeneous setups across all markets, and you want symmetrical setups. So the buy setups should be complete opposite or flip of the sell setups, right? Don't tweak it to say, oh, we'll have, equities always go up, so we'll have a different buy setup because they have a tendency to be biased to the upside, and they'll have a different sell setup because we know that equities or indices have a tendency to always be going up. None of that, because guess what? Markets do not go in one direction forever. Believe me, markets change. They overshoot and they undershoot. So so you just need to understand these key attributes of winning strategy. So when you're designing your strategy, go think to yourself, have I got homogeneous setups? Do I have symmetrical setups? Do I have few rules, few filters, a few variables? And also, when you do have variables, try and keep the variable value the same across the verticals of your strategy. Okay, so if you've got a variable value of, say, X, and you've got a couple of indicators, well, use the same value of X in all the indicators, right? Don't just pick another value for a different indicator. Now, I know it's not all indicators are the same, and you do have indicators which are different, but try and keep, as a general idea, the variables the same. So you just need to understand that. And then finally, before you start, I strongly suggest people go and look for a really old idea that has been out in the public domain for years and years and years, and see if it can give you any clues to help you start your strategy. Reason being is, when you develop your strategy, you may have indications of robustness, but you've got no evidence, right? Because it's brand new. Well, one way to give you confidence that you're, apart from the indications of robustness, what will also give you confidence is that you've taken an idea that's been known for 10 years, 20 years, 15 years. You just go back to the old trading books and look at some ideas and go, you know what? I have pinched or borrowed or copied a key element out of that strategy. I've taken its backbone and I've made it my own. And yes, I know that it's mine and I've got no evidence of robustness because it's brand new, it's mine today. Well, you know what? It gives me a lot of confidence that this strategy that I'm using as a backbone has been known for 10, 20, 30 years. So it just gives you that a little bit of confidence that you've taken an old idea. Does that make sense?
Yeah, definitely another, and I think that makes a lot of sense. Now, I was surprised to hear you say that you should look for a strategy that works in all market, and really to be more kind of like hands off, where you can trade all markets. You don't focus on like just your favorite, and most people will say just pick your favorite markets, trade those markets, but you go the opposite, which is insightful and quite different. So it's good to hear.
Because you want to make sure your trading is robust, that it's got legs. It doesn't have to be fantastic on every markets. But you know what? It's got to be profitable on a portfolio of markets, because what we all want, we want the proverbial, holy grail of trading, which is a money-making trading strategy that doesn't lose. That's what we want, a methodology that doesn't lose, and that's the epitome of robustness. And so you just got to understand the best way to design a strategy is, a good indication of robustness is your idea, even though you only trade interest rates, or you may only trade pork bellies, you may only trade soybeans, I don't know. But to give you every chance to be successful, it's got to be profitable over a diverse portfolio to prove to yourself that you have not overly curve fitted your idea to your preferred market. Yeah. So you do that. And then you get the idea and off you go. You just do a lot of iterations and see what happens, and try and be sensible and don't put too many rules in, right? And once you have something that you think has a positive expectancy, right, you're happy with it, that you tick as many boxes as you can of indications of robustness, like it's simple, few rules, few variables, homogeneous, symmetrical. You've used basically the same variable value across indicators and for all markets. You're happy, right? Then I believe you should do what I call is an equity curve stability review, okay? Which is basically sensitivity analysis, right? So what you do is you will have your preferred variable values. X equals 20, Y equals 10, right? Two variables in the strategy. They appear to be the sweet spot for you, right? Most strategies have variables in them, okay? Now, once you have two variables in a strategy, you need to work out and calculate the alternative universe of equity curves. Because even though you, in your heart of hearts, believe that X equals 20 and Y equals 15, whatever it is, even though you're happy in your hearts of hearts that you'll never change those variable values, right? I can guarantee it that there'll come a time in the future where you'll tweak those variable values as you try and capture more historical profit by adjusting your variable values. And so what you need to do is to work out what's the size of the alternative universe containing the additional equity curves. Okay, yeah, you're trading one potential equity curve. Your strategy has two variables, X and Y. X is 20, Y is 15. That will give you a particular shape on your equity curve, right? Well, guess what? If you've got two variables, and what I do is I try and make 4 changes per variable. So I make 2 10% adjustments above the variable value and two 10% changes below a variable. So if one variable is X equals 20, 10% of that to me is 2. So I want to see an equity curve where X is 22 and where X is 24. Also, I want to see an equity curve with X equals 18 and X equals 16, right? But we also know we have a variable Y over here. Y is 15. 10% of 15 is 1.5. So I want to see an equity curve with Y at 16 and a half, and then at 18, and then at 13 and a half, and at 12, right? When you have two variables and you are making a minimum of 4 adjustments to each variable, that gives you a total of 25 equity curves, right? That's all the combinations you can have, 25. So an equity curve stability review will calculate each one of those 25 equity curves. And for each equity curve, you need to calculate the individual risk of ruin. If any one of those variable combinations produces a risk of ruin above 0%, you have to walk away. Because even though in your heart of hearts, X will never change from 20 and Y will never change from 15, I can guarantee you will tweak those values. And with the equity curve stability review, by only making 10% adjustments above your preferred value and 10% changes below your preferred value, and it's only 4, it's not much, but it will give you 25 different possible equity curves. You need to calculate those, calculate your risk of ruin, and then also look at the variability of the equity curve. So you need to know 2 things. 1, are there any calculations of ruin above 0%? And if there is, you need to walk away. And secondly, how does the shape of the equity curve change? Is it minor, or is it like a rodeo horse, like really vicious, really like a roller coaster? Because if the changes are huge, it's like a roller coaster, then for you and I, it's no good, because the equity curve would be too volatile for us to trade. Yeah. Once you've completed an equity curve stability review and you have no equity curve calculations with risk of ruin above 0%, once you're happy with the visual appearance of all the alternative equity curves, they're not too volatile, then you're getting really close, right? You then take what you've developed and you compare it to your benchmark. And I recommend people should look at the turtle strategy and compare it against the turtle. Sure, you won't have that same out of sample performance data, but you can look at the indications of robustness, which is look at have you followed good design principles? Because look at the turtle system, very simple, only 2 variables. It's got homogeneous setups, it's got symmetrical setups. How does your look? Right, and you got to be honest. You got to compare what you've done against the turtle, and if you think yours is superior to the turtle, then you're almost on your way. And before you decide to trade real money with your good strategy, then you need to follow what I recommend is follow the test procedure. So you need to get a trading buddy and do at least 30. Test stands for 30 emailed simulated trades. Okay, so you need to say to your buddy, you need to help me. I want to trade this strategy, live with you. You're going to become my virtual broker. So please, can you manage 30 of my next trades according to my strategy? I'm going to email you my orders, and you'll see there's a timestamp on your emails. And please execute, my order on a piece of paper based on what my order instruction is, and you have access to the markets, right? And when I get executed into a trade, I will email you my trade management instructions, and I'd need you to become my bookkeeper and keep me honest, and only record my results based on the fact that there's a timestamp on my email, right? And I can only enter and exit and adjust stops after the timestamp. Yeah. do 30 of those. And if your 30 simulated email trades are positive, I don't know what else you can do to prepare yourself to be in a position to engage with the markets. So I know I've spoken for quite a bit, but I think there's quite a prescriptive approach to developing strategies. It's got to start. You need your tools, the right tools. Get yourself a benchmark. Understand what the attributes are of winning strategies. You want to copy those attributes into what you're doing, and then you need to create, or you've got to define your universe of alternative equity curves, and that's a function of how many variables you have and a function of how many adjustments you will make to each variable. I only make 4, which is not that high. You could make 8, really, but I do 4, 2 above and 2 below. And if you only have a simple system with 2 variables, that will still give you 25 possible equity curves that you need to calculate. If there's no risk of ruin, calculation above 0%. If the changing shape of the equity curve, is not too variable, then compare what you've done to your benchmark. And if it's superior to your benchmark, complete your test. Your 30 email simulated trades with a trading buddy who will become your virtual broker and bookkeeper. And after those 30 trades, he or she will tell you how you went. And if it's positive, I believe you can't do any more than that to have your best shot in being successful.
What would you tell someone who wants to start to code their ideas, but they have a way of seeing the market where some things just cannot be coded? Like, for example, they look at support resistance areas, or they have a way to look at the trends that can only be seen in the chart but cannot be coded. Should they find a new way to kind of look at the market, or can they kind of keep part of it manual, part of it coded in their strategy?
Yeah, I've heard a lot of people say, I know technical analysis, and I'm going to keep it very simple. I'm going to trade with the trend. I'm not going to trade against, say the 200-day moving average, and I'm just going to trade simple chart patterns like head and shoulders or triangles. And that sounds very reasonable, right? It sounds very reasonable. But I think even though it sounds reasonable, you still need to code it up. And I honestly believe if you can describe something, you can code it, right? If you can describe something, you can code it. You may not like to code it. You may not know how to code it, but in time, you will work it out. So for me personally, I wouldn't leave anything to discretion, not anything. Because I think if somebody can describe to me how they'd like to trade, but they feel that it's impossible to code, I'll be going, no, well, you've explained it to me. If I can understand it, then I'm sure somebody could code it. I mean, I may not be able to code it. You may not be able to code it. They probably can't code it yet. But if they feel the idea, has currency, then they will work out how to code it. Get it coded up and run your historical equity curve. Work out how many variables you have. Do your equity curve stability review, where you work out how many alternative unit equity curves there are in that parallel universe, to see if any of those different variable combinations has a risk of ruin over 0%, and on we go. So I think discretionary traders, that they like to sort of say that, well, I'm a discretionary trader, and also I'll wait to see how I feel on the day, right? You may say that's impossible to code, and guess what? You're correct. If a discretionary trader says, I'm very mechanical in my setups, but I have my discretion on whether I take those signals or not, that is very hard to code. And I know there are successful traders who are discretionary mechanical traders. You're probably very, very aware of Larry Williams. Larry Williams is a discretionary mechanical trader. So Larry is very, very model based, right? So he develops models all the time, and he's got all the measurements right, the setups. but he will make the final decision on whether he takes it or not. That's probably impossible to code, because how can you code how somebody feels on the day, right? So maybe there isn't an element that you can't code. If somebody's saying, well, I just see how I feel on the day, I'd be saying, well, it's probably not the best, unless you got many years of experience like Larry Williams. For the average trader, I wouldn't suggest that's the best way to get started. I think when you want to start, become as mechanical as possible, become mechanical or systematic. And as the years go by and you get more and more experience, then maybe you can introduce an overlay of discretion. But I can assure you, I've been involved in this market for 30 years, and every time I've sort of tried to do a few things, it's cost me money. So for me personally, I stick to my lane and I stay in my lane. If my model says buy, I buy. If it says to sell, I sell. If it tells me to put a stop here, I put the stop there.
So we've got a lot in this interview. I know there's going to be a lot of things people can apply, and I want them to take action on this and really use it for their trading. So what can they connect with? I want to reach out after this interview is live and connect with you and learn more.
I just really encourage people just to look at my books. I have a lot on my website, and my website is, you know what it is. There's a lot of information there. And what I say on my website, if they follow the educational tabs, is if they want to understand how I approach the market, the best thing to do is to buy my 2 books. Start off with the Universal Principles of Successful Trading, right? And you read that. And I'd give this advice to any trader who wants to learn from another trader or an author. I'd be saying, take baby incremental steps, right? Spend a little bit of money and try and understand, where they sit in the markets and how they think about the markets. So for me, if people want to understand how I approach the markets, then buy my Universal of Successful Trading book and understand my philosophy of trading. If you like that, if what I say resonates with you, then get my second book, The Universal Tactics of Successful Trading. It's a very good book. And I actually go through that process we just discussed on how to develop a trading strategy. And we actually develop a strategy in the book called MWDT. It's called MWDT. Okay, so there's actually a fully disclosed strategy in there. I even invite people to contact me if they want to get an update on the equity curve. So for the price of 2 books, people will get a thorough understanding of, how I think about the markets. And if they like that, then I have a couple of video courses on my website that people can, just take incremental steps, right? Spend a little on books, get to know my approach. And if they like it, they can spend a little bit more money. And there's like an introductory course and there's an intermediate course. And we'll probably put up an advanced course in the next 6 months. And my overall educational concept is called a pathway to sustainable trading. So a pathway to sustainable trading, because everyone's objective should be not just to be profitable tomorrow, but next year and next decade. And my pathway begins with my books. So small investment gives people an understanding of where I come from. And if they like that, then they can take another small step and they can build up to the introductory course, which includes 9 hours of video tape. And then there's an intermediate course. And in 6 months' time, I'll probably put an advanced course on top of that. And I think that is basically the ultimate pathway. The best I can offer people, basically, the best I can offer, starting with the books. Yeah.
Cool. Thank you, Brent. I appreciate your time. And I think it's just really insightful for people to go through. And it's a process that people will need to go through for sure at some point. So I really appreciate you sharing this here for us today. And I hope we catch up soon. Thank you for your time. And I will talk to you pretty soon.
Hey, thank you. And thank you for having me.